Rebecca, let me start with you and what the Fed has in front of it. What is it trying to do?
Well, the Fed is trying to get Goldilocks, and that means it wants to get inflation back down as fast as it can towards its 2% target without engineering a recession. And the market is giving it the benefit of the doubt. If you look at what's discounted into markets today, it is basically 2.5% inflation in just over a year and only a moderate slowdown in growth. And I think it's going to be almost impossible for the Fed to get everything it wants here. The porridge is going to be too hot or too cold. Either inflation will end up running much higher than the Fed's target and they risk losing their credibility, or if they're serious about getting inflation down, especially from the current high levels, it's going to require more tightening, which we think is going to engineer a deeper recession. And that's what we're focused on. We think that within 6 to 9 months, we're going to be looking at U.S. GDP that's -2%, -3%.
So, Sarah, where are you on this? Because there felt like a tension this week between the markets, the futures markets on the one hand, saying exactly what Rebecca just said, and economists on the other hand saying, you know what, we got to really jack up the rates a lot to get inflation under control. Which side are you on?
The more skeptical side. I think that's how we are as value managers, always want to have it proven to us. But note that we've had so much liquidity created, $4 trillion of enlargement to the Fed's balance sheet since the beginning of the pandemic in early 2020. That's a lot of liquidity, and it's still there. The Fed only just started to from a quantitative easing to quantitative tightening starting June 1 of this year. And it's just beginning, and it'll go from 30 billion a month and then bump that up to 60 billion a month. And letting those bonds roll off. That, again, starts to compress bank reserves. This will be quite lagged in its effect. So financial conditions will just tighten due to that reason alone. And we don't think markets anticipate that at all.
And I think just building, Sarah, on your point, it's important to remember that the markets are really looking at the rates. They're not thinking as much about quantitative tightening or the roll-off of the Fed's balance sheet, which is on autopilot. That's going to keep going. And so we don't have the Fed buying bonds. We don't have banks buying bonds anymore. And so we've seen bond yields come down in the last couple of weeks. But how much further can they come down without retail investors, institutional investors moving out of equities into bonds? I think what we've seen historically is when stocks go down, bonds rally, and you get that diversification. We've had that for the last few weeks. We didn't have it for the first half of the year. I don't think we can count on that as we get QT continuing, quantitative tightening continuing. Bond yields may come down, but it's going to be a lot harder for them to do that in this environment where the Fed's created a liquidity hole. It's taking liquidity out, and it's not as clear today who's going to fill that, who's going to supply the demand to keep bond yields going further down.
So let me pursue that liquidity issue a little bit, Sarah, because you mentioned it, the lack of liquidity. That really makes the markets, as I understand it, much more volatile. So what does that do to an investor? How do you have a GPS at this point, given where we are?
The key is to have a low entry price because you've got to have that margin of safety. And what this will mean, if massive increases in liquidity, and again, this wasn't just the Fed. Central banks globally were all at this, the European Central Bank, the Bank of Japan. And as they all in unison take liquidity out of the system, what pushed up market multiples, what made valuations expand, what made investors indifferent to valuation, it'll be just the opposite. And we've already seen that start because some of the hardest hit stocks globally, including in the U.S. market, had the most bloated valuations. So that we can expect more of that in the future, where those stocks which had valuations unjustifiable based on the kind of cash they can generate are likely to see a re-rating downward.
And the thing that we're watching really as we go forward is what happens to growth and therefore earnings. We expect that there's still a shoot-a-drop here with a reduction in earnings expectations. We're seeing early days consumer confidence, that outlook expectations component this week, lowest level since 2013. Confidence leads activity. Activity is going to flow into earnings. If someone's spending goes down, that affects someone else's income. And so we think that even though stocks in the United States have fallen quite a lot year to date, that's almost exclusively reflecting higher discount rates and higher risk premium. We haven't seen lower earnings baked into equities yet, and we think that's still ahead of us.
It's a really good point because margins in general across all industries are near peak levels in the US. That's not usually a sign of a continued bull market. And furthermore, look at just some of those basic indicators like market cap to GDP. Take the US market, it's at its another high level similar to where it was in prior to past or at past peaks, say the top of the global financial crisis and also the TMT bubble in the late 90s, early 2000s. So none of those bode well for a market that supposedly is going to keep marching forward.
At the same time, Rebecca, we've got data going in two different directions because GDP is down, consumer confidence, as you say, is down. At the same time, personal spending is up, and there's still a lot of money on the balance sheets, household balance sheets, as well as a lot of corporate balance sheets.
Yeah, so what we've seen is initially, as we were coming out of the pandemic, if we can say that even, I'm not sure, people were spending down the excess savings, the stimulus they received as a result of the pandemic. That is back down. Savings rate is back close to 5%. And the spending is being prolonged through credit. So people are now tapping into their credit cards to keep that spending going. But as interest rates continue to rise, the cost of servicing that credit continues to rise. We think that's going to be another inflection point lower and an important marker to watch to see when does consumption start taking a bigger step lower.
So, Rebecca, I'm sorry, Sarah, when does the other shoe drop on credit? Because if interest rates are going up, as Rebecca says, sooner or later, you got to pay the piper.
Well, what will really spur a blowout further in spreads, and therefore that's going to have ramifications across the U.S. economy. In fact, globally, will be as inflation gets beyond, again, to our point, what the Fed is anticipating, and we may see some of that centered in housing. The momentum we're seeing in rents looks unstoppable, and that will have a very big impact on CPI.
I think that's a great point. You know, a lot of people are looking at the housing activity, which has really slowed quickly as mortgage rates have gone up, and said, oh, well, housing inflation will be gone in a blink. But really, as people can't afford homes, then they rent. And rents are still resetting higher. So we have rent inflation that is still marching higher and housing inflation, given the very, very constrained supplies, and now rising household formation helping demand at the margin. We think we're in a position where housing inflation, partly due to rents, is going to be sticky. Wages might start to moderate, but they're going to be relatively sticky. Both of these things are a big reason why we think inflation is not likely to get back down towards the Fed's target as quickly as the market's price.
Especially, Sarah, because people still have jobs, and if anything, wages are going up.
They are. They're going up here, and the labor scarcity, just anecdotally, everywhere you go, you see the signs help wanted. And it just seems as if a portion of the labor force just vanished. And it's not, again, specific to the U.S. We see this in Europe as well. They're kind of crying need for more labor. And whether immigration can fill that gap is very debatable.